Hello and welcome to this Maritime London webinar in partnership with MDS Transmodal. I'm Standerwick, Chief Executive of Maritime London, and I'll be moderating today's session. And particularly for those of you in the UK, thank you so much for joining us and not choosing to spend your lunchtime in the beautiful sunshine that we're experiencing at the moment. The performance of the liner market since mid-2020 and the consequential lack of capacity, I think, has exceeded even the most optimistic forecasts made at the start of the COVID-19 pandemic in the West. This creates an interesting dilemma. For the carriers, it is, of course, good news, and many commentators now urge caution in regards to rushing to the yards to order the next batch of 20,000 TEU ships and cutting rates as profits rise to stay off the worst excesses of the market that is renowned for its boom and bust cycles. And one, of course, must remember in the long term the challenges of decarbonisation, potential deglobalisation, and, of course, the delayed pain I think we can all expect to feel when government incentives are globally withdrawn. However, I think the current trends have created challenges for shippers, for port operators, and the wider logistics supply chain. And of course, anyone who's tried to buy anything from a hardware shop will testify, the consumer as well. So perhaps unusually for Maritime London, this webinar will focus on that side of the coin, I suppose, as we get perspectives from the shippers in the form of James Hookham, Chief Executive of the Global Shippers Forum, and the ports from Tim Morris, Chief Executive of UK Major Ports Group. And to start the presentations, we have Mike Garratt, Chair of MDS Transmodal, who will provide an overview of the Global Shippers Forum, MDS Transmodal Container Shipping Market Quarterly Review for Q1 2021. That's a long title and an even longer sentence, but there we go. Before we get started, I'll provide a quick run through of housekeeping notices. We're all well versed in webinars now, but if we do experience any technical difficulties, please do bear with us. We'll do our best to minimize background noise, but at least one of my children is currently playing out in the garden, so I'm sure you'll hear some screaming at some point. This webinar is being recorded and will put onto our YouTube channel, and all those who have registered will receive a link to the video. And lastly, but most importantly, you will be able to ask questions in the text box, and I'll try and weave in as many of those questions as I can during the session. Now, without any further ado, I will pass the baton over to Mike. Mike, over to you.
Thank you. Good afternoon, everyone. I'm very pleased to be speaking to you, and thanks to Joss for that introduction. And I'm trying to I do apologise. I realise I was at the wrong end of the presentation here. Right, I'll start talking anyway. What I'm proposing to do today is to go through our quarterly review as a means of discussing supply, demand, and competitiveness in this sector. I'd like to, as a bit of a preamble, though, explain to you. Thank you very much. Right, we're away. Right. What I'd like to do is to start off with a bit of a preamble as to why we came to do this. Many of you will be aware of the debate on the consortium block exemption regulation, which has taken place over the last few years, led by the European Commission. Led to the Commission deciding in March last year to extend the exemption for another 4 years, i.e. to not decide to do that indefinitely, but to just put the decision on hold. The Commission stated in arriving at that conclusion that despite the number of organizations that had questioned its extension, there was a lack of data, particularly a lack of data on market share, to actually arrive at any other conclusion. And what then happened was that the Global Shippers Forum, in making its commentary on this kind of decision-making process, came up with a proposal which was, quote, the establishment of independent and more frequent measures of market performance using respected intermediate agencies such as OECD or UNCTAD. Now, we do quite a bit of work with UNCTAD. We produce their liner shipping connectivity index, which is UNCTAD's way of trying to assess whether liner shipping does a good job for the global economy. So we got in touch with Global Shippers Forum, with James Hookham, who you'll hear from in a few minutes, and suggested that what we could do, because of all the databases we've been developing over the last 25 or more years, what we could do is try to come up with a review of a lot of quantified measures and produce that quarterly to allow Global Shippers Forum to make commentary on what those numbers might actually mean for its members and for the wider community. So what you're seeing today is our statistical analysis. We've done 3 quarterly reviews so far, and we propose to do this indefinitely. And then you'll hear from James as to what or how he interprets that. So these are the key performance indicators that we are covering. Demand, supply, utilization, cost, revenues and profitability, competitiveness, i.e. market shares, connectivity, performance, and finally carbon per TEU. Some of these kind of fluctuate more quarter by quarter than others do, of course. And what I'm proposing to do is to go through each of those 8 with a number of slides to give you an idea about the kind of results we come up with and in a sense, inviting conclusions from a wider audience. This is a cut-down version. What we normally do is we also feature a particular trade corridor. So this quarter we were looking at West Africa, the previous quarter was Trans-Pacific and so forth. So, but in this version I'm showing you today, I've sort of cut those out for the sake of brevity. If anyone wants a copy of this, they're very welcome, and there is an email address at the end you can write to. So we start with overall trade volumes, what's been happening in the world, looking at all commodities, not just unitized, but the key figure to look at is the unitized figure, which is the last but one row on this table. And what we see is a 7.2% growth over the same quarter in the previous. On the right-hand side, you see that graph, and you could see that tremendous dive that took place in the beginning, or quarter 2 really, I suppose, of last year, and then a huge level of recovery, so that unitized cargo, which is the green line, actually got to levels never hitherto seen by the end of last year. So we focusing in on unitized cargo and looking at maritime containers. There are other forces, intra-European trucking and so forth, all of which we're covering in the review, but focusing on the maritime containers. And you can see year on year, quarter on quarter, a 13% growth rate, although as compared to the previous quarter, which was quarter 4 last year, there was a slight drop of 1.2%. Quarter 4 last year was the busiest ever experienced by the global liner industry. And you can see on the right-hand side the graphic that describes all that. And it was maritime containers rather than all other unitized, intra-European particularly, which was growing so quickly. So moving on to which routes were they on? Well, east-west routes grew the fastest. That is basically Far East to North America and to Europe, at 15% growth over the quarter of the previous year. That hasn't been matched by a growth in capacity. Now, what we do here, we look at deployed capacity and the number of ships. So the top half of this table shows the total deployed capacity in TEU, broken down by ship type. But if we just look at the row halfway down the table, total deployed capacity, millions of TEU, you can see that as compared to the previous year, only a 3.8% growth in capacity. So capacity growing more slowly than demand. And here we compare supply and demand. And the left-hand bar chart is comparing demand, which is orange, and blue, which is deployed capacity. And the green line is comparing the two. And you can see that Q4 last year reached an absolute peak, and it dipped slightly in the first quarter of this year. If you look on the right-hand side, you can see, and this is scheduled capacities, you can see that in the green line, the utilization level was dipping, but the number of port calls actually achieved, as compared with what was in fact scheduled, started to deteriorate significantly. And I'll come back to that performance aspect again in a few minutes. But what we have seen is that the performance of the line of services have deteriorated. This is just focusing on the, as it were, the global pinch point through Suez. Obviously, that was rather dramatically illustrated a few weeks ago with the grounding of the container ship, But here again, we can see how supply and demand can be compared. But in this case, note, there was a cut in capacity, particularly through Suez, as the global line of services switched capacity to elsewhere in the world, i.e. the Pacific, because that was growing more quickly. So utilization levels grew significantly. It's often said that shipping suffers from a great cyclical problem, i.e. difficult to predict what will happen next. So the lines go and build too many ships and then don't build enough and so forth. Now, this is not in our quarterly review, but I thought we'd throw this in to kind of bring these issues together at this point. This is looking at events over a longer time scale, in this case, taking 2010 Q4 as the starting point, as really the first quarter you can say reliably is post the financial crisis. So things have kind of got back to some kind of normal by then. And the yellow line is showing demand, and the blue line is showing supply. Total deployed capacity globally. And what I think we see there is relatively stable relationship. Some years supply grows a bit too quickly, such as 2015 Q4 there, you can see that. And then the next year, it doesn't grow at all, so demand catches up and so on and so forth. Now, the crucial point I want to make here, though, is if we go back 3 years to end of 2017, and you look at the trends up to that point, the basic growth trend had been over those previous 7 years about 3.94% per annum, something of that order. And so I think it's reasonable to assume that if you were trying to predict how much capacity would be required 3 years later and built new ships accordingly, 3 years later the ships would be out there on the sea working, then you'd have quite reasonably carried on assuming a growth rate of 4% a year. And in fact, despite the huge growth that occurred at the end of last year, it still didn't quite reach that. And you can see there that the dotted line, which was the trend line, is slightly higher than the actual demand. But supply didn't anywhere near keep up in terms of deployed capacity. Now let's look at costs and revenues. We estimate these costs, of course, based upon relatively well understood parameters, bunkers, charter rates, port costs, and so forth. And all of these we cross-check against available shipping line accounts so that we know we're in the right order. Just focusing on the left-hand graph and the solid blue line, you can see that while there have been fluctuations over that 2-year period from 2019 quarter one to 2021 quarter one, basically the costs have come back to about the same place. They're all based, indexed to 100 here. But the freight rates haven't done that at all. The freight rates over the last 6 or 9 months have shot up. Those we show on the right-hand side. The solid lines, show data from container trade statistics, which is effectively the shipping line's own data. The yellow line is the Asia to Europe rate, and the blue line is the Asia to North America. Those are the mean revenues received by the lines, but the spot rates, which is shown as dotted, have gone up at an extraordinary rate, as many people will appreciate. This is another way of looking at costs and revenues. Simply comparing costs and revenues with and without the allowance for bunkers. And if you look on the right-hand side, where we've taken the bunker effect out of both costs and revenues, you can see that while our estimate of costs over the 2 years period have gone up slightly, the revenue figure, and that is from container trade statistics effectively, has shot up. Now, we then move on to competitiveness, and what this basically means is asking the question, how many independent players are there on a given trade route? Now, we can have a long discussion about what constitutes independence in an industry where there's a huge number of, as it were, cross deals, vessel sharing arrangements, joint services, and so on and so forth. So just to keep it simple for this graph, in our review, we do something more sophisticated. We have simply looked at the shares, as it were, 2020 plays 2021, of the capacity offered by the 3 alliances, 2M, Ocean, and the Alliance, and all others combined. And you can see the all others combined continue to decline, and they're at about 12 or 13% now. Moving on to port connectivity. This is what we do for UNCTAD. We take into account a whole range of different factors: ship size, service frequency, and others besides, which I'll show you in a moment. And we compare connectivity back to a base year, which is 2006 Q1, being an index of 100. And then we plot how these change. UNCTAD's main interest really is to make sure that some places are not, as it were, falling by the wayside. And in this comparison, green is good, red is bad. We can see that for these ports, the 10 leading container ports, probably more positives than negatives. And again, looking at on the graphic on the right-hand side, you can see that there is relative consistency, I would say. Now this shows you how the index is broken down into by numbers of services, number of port calls, maximum ship capacity, number of operators, so choice, and so on and so forth. And we've looked at one particular port here, which is Rotterdam, which it happens that in this quarter, compared to the previous year, it's coming out rather negatively. But again, this is done for every port, or can be done for every port, every country, whichever one wants to look at. Now, service performance, sorry. We've developed 3 measures of service performance. One is consistency, that is, does the ship or the service turn up within 6 hours of when it normally turns up? Reliability, does it turn up on the same day as it normally turns up? And the third is port calls, which is basically, does it turn up at all? Because, of course, there's been a number of ports which have been skipped or services blanked and so on and so forth. So we compare. We can compare this. Make this comparison for any service, but this is the world together. This is the grand sum total, if you like. And what you can see is that over the time period we're looking at, the last couple of years, but we can go back earlier than that. You can see there was a big dip at the beginning of the pandemic. Then there was a recovery, Q2 last year. Not much cargo, so the ships had no trouble staying on time, but still a lot of port calls being missed. And then there's been deterioration since then as port congestion, lack of containers, the whole range of issues, which I'm sure we'll talk about in a minute, kick in. This is just looking at Rotterdam's experience, which is not dissimilar. And in fact, Rotterdam's position is pretty well the same now as it was 2 years ago in terms of performance and port calls. And finally, and this is something we monitor over a much longer time period, our estimate of CO2 emissions per TEU, where the lines, of course, have done very well. If you go back long enough to before the end of the conference system, back to, say, 2008, then you see that CO2 emissions per TEU moved have improved enormously, but that now is tending to flatten out. So I'm now going to hand over to James, and he will basically read you through what this all means for shippers. Thanks, James.
Well, thank you very much, Mike, and good afternoon to everybody. Well, I hope you've seen from that presentation just how comprehensive and authoritative the MDS Transmodal Data Bank is, and the insight and depth of knowledge they're able to bring to an analysis of this market. And may I, at the outset, thank Mike and his team for the offer of cooperation here. It's GSF's job as the global voice of cargo owners to interpret this data and inevitably reflect its opinions of what's going on from a shipper's perspective, from a cargo owner's perspective. And I think it's important, given the global scale of some of these effects, just to remember that we're not just talking about a disgruntled group of parties in to contracts. We are talking about importers and exporters around the world that are struggling to keep international trade going, keep their economies growing, despite the pressures of COVID and despite the pressures of we've been talking about within international shipping. So our interpretation of what's going on is probably not going to surprise you very much. We see that trade volumes have recovered and indeed exceeded where they left off at the end of 2019. But I think importantly, and you've seen the graph that Mike introduced into his presentation just now, that is pretty much on trend. Although volumes continue to rise, they have almost carried on from where they left off at the end of 2019. So in one respect, the growth in volumes shouldn't come as much of a surprise if you were following closely and projecting forward the trend growth from 2 or 3 years ago. But nevertheless, the shipping capacity available to shippers to move their goods has flattened out. There is barely any other capacity in the market today than there was at the end of quarter 1 2020. We respect that there was a sharp downturn in that quarter 2 period last year when China stopped producing as the pandemic spread through Chinese manufacturing industries, but it's come back, it's caught up, but the capacity has not returned to the market at a pace fast enough to match those goods. And inevitably, the squeeze on capacity has led to this sharp jump in first spot prices, a lot of which has been baked now into contracts as they've come around for renegotiation over the past 6 months or so. Inevitably, at high spot rates and indeed contract rates, it makes sense to fill your ships as much as possible. And it's no surprise that capacity utilization is showing very, very high levels. And in effect, ships are running full. And this is obviously the reason why so much cargo is rolled over. And indeed, many ports are simply skipped because vessels are simply not got the capacity on them to pick up what they hoped to or expected. It really is maxed out at the present time. Now, the important thing that the carrier costs and revenues tell us is that these are simply market effects. There is no underlying pressure on rates because of increases in carriers' costs. Indeed, they dipped last year as the oil price plummeted. And are back to no higher levels than they were a year ago, and yet unit revenues are way ahead. And this continues to enrich the major lines active in the main alliances, and the graph clearly demonstrates how difficult it is to act as an independent carrier in these sort of circumstances. I'll skip over port connectivity. It might be something we return to in discussion with Tim in just a little while, but the real crunch point for a lot of shippers is, of course, the fact that the service performance, the predictability, how predictable are the delivery and arrival of boxes at destination ports, so that importing shippers can arrange for those boxes to be collected and brought into distribution centres, and then the goods actually distributed to end consumers. How important, how reliable are those deliveries? That too has plummeted and continued to decline throughout the year, leaving a very nasty taste in the mouth of shippers that here they are paying record rates for a service that is increasingly declining in performance and in predictability. The final factor, as you've heard, that we are monitoring and keeping an eye on, especially given the discussions that will be taking place at the IMO next week in its Maritime Environment Protection Committee, is the carbon footprint of shipping. Maybe something we can return to at a future event. But in terms of assessing the overall performance of the liner shipping market and its impact on its customers, its shippers, we've included this factor as being certainly one that we will be watching in the future. So we're not happy as shippers is the bottom line. Clearly, we are the victims of the circumstances in this terrible pandemic that has inflicted the whole world. But shippers have long been dissatisfied with the shipping industry apparent magical ability to cooperate in ways that would land any other business owner in jail. The exemptions that are provided, not just by the European Union, but by competition jurisdictions all around the world, are quite unique, quite unprecedented. The Global Shippers Forum was instrumental in bringing an end to the liner conferences in Europe back in 2008, and we have continued to monitor the degree of openness and competition in this market on behalf of our members, and the opportunity to cooperate with MDS Transmodal and have access to this huge wealth of data has allowed us to continue to monitor and pay close attention to this market and ensure that regulators are aware of how we perceive the market and how we as shippers are reacting to it. There is a presumption in favour of renewing the block exemptions, not just in Europe, but around the world. And therefore, this evidence base that we're building will be vital in putting forward a contrary view, a counter view to the Commission and indeed to other jurisdictions as they review those the arrangements in due course. And of course, a number of other jurisdictions have started to look hard at exactly why the shipping industry has behaved in the way that it has. Well, these are just the reviews that we are aware of. Significantly, the Federal Maritime Commission announced not just an investigation, but a wholesale reform, seemingly, of the core primary legislation that affects shipping services in the US, and the FMC will be conducting that over the next few years. The authorities in China have announced a review. We expect to see one commence very shortly in Australia. Singapore is renewing and reviewing its consortia block exemption arrangements at the moment. And Vietnam joined this list just last week. So in asking the European Commission to review its decision that it took last year to simply extend the block exemption without condition for another 4 years, we are not alone, and we hope we can point to these other examples elsewhere in the world of where governments, aware of the wider impact of the performance of the shipping industry on their economies, have chosen to look again at exactly what arrangements are in place and whether or not they are actually acting in the best interests of consumers and customers of the shipping lines. So I hope you found that presentation by both of us interesting and relevant. We're now going to pass on to our next speaker, and I'll hand you over to Tim Morris. Tim.
Thanks, James, and thank you to Mike. It's good to have a fact-based discussion rather than the sort of more anecdotally driven discussions and talking points that frequently cloud this kind of debate. So my name is Tim Morris. I run something called the UK Major Ports Group, which is a trade association for the largest port operators here in the UK. Our membership includes all of the sort of large deep sea container terminals here in the UK. From that, given that, you probably be unsurprised to know that my perspective is largely driven by the UK. But I'd be very surprised if some of the things that I'm about to say don't resonate with port operators, more generally. And the overall point is, it's been a very challenging year for the operators of deep sea container terminals, and I guess that's in a number of ways. The first of which is just the simple aggregate level of traffic and Mike's numbers demonstrate that quite clearly. And although his numbers show a slight drop off in the current quarter, the quarter one 2021, I can assure people that it still seems very busy to us. And although it might be a slight dip, that's still a dip from, as Mike said, the busiest ever quarter. I think the point would be, two other points would be, it's not just about the aggregate level of demand, it's about the volatility of that demand, both in terms of the movement through the year, the changing patterns through the year, but also in terms of, and this is crucial, the sort of reliability stats that were in the MDST data as well. It's one thing having a large volume of containers. It's quite another to have those arriving sometimes almost at random. And then the third element that's made it very challenging is the actual physical positioning of boxes, and or uneven position of boxes around the year, and not only moving containers full of the material heading to James's members, but also then repatriating those boxes generally back to Asia. All of these things have made it a very challenging period for ports, but also it's important, and James's members, they get fed not just by the container liners, not just by the ports, but also the truckers, the rail operators, etc. The whole system, the whole landside system in itself has been under tremendous pressure, as not only we've responded to the level of activity, but also the unpredictability of that activity. 6 hours plus minus a berth time might not seem like a lot when a vessel is traveling around the world, but when you've got a long queue of angry truckers lined up waiting to go, 6 hours can feel like a long time in a vehicle booking system. How has the port sector reacted to this? I think a number of ways. Number one is we haven't been confident enough yet to go down the line of wholesale large scale investment against sort of current peak levels of demand. That's a tricky thing. That's a high risk thing to bet for at this point. But I think what we have learned to do is it sort of accelerate the trend that we were on previously about the flexibility in the way we work, the ability to deploy surge capacity, and in many ways that's been an important part of the dialogue that we as port operators have with our social partners in the trade union movement and people on the ground. But also in terms of the responsiveness and engagement with end customers and the shipping lines as well. So trying to build that more visible picture of where people's boxes are, where they might not be, how long are they going to move through, etc. The more data equals the more information, hopefully means that we're able to operate in a sort of more flexible way, given the uncertainties in the physical environment as well. And we see much more of that coming down the track as the way to provide more efficiency and resilience in a supply chain. Here in the UK, a number of these factors have been compounded by Brexit, but we could go on to talk about that. And obviously in Europe, sort of more generally, the Suez situation has demonstrated the need for some of these characteristics with bells on. So with that, I will probably hand back to Joss to take us through the Q&A, I think, Joss.
Tim, James, Mike, thank you so much for that overview, and Mike for your presentation, which was incredibly informative. And just to sort of borrow from that presentation, it feels to me that in the medium term, at least, the market has worked in relative harmony, where the supply has largely matched the demand. That's sort of my layman's interpretation, anyway. And given the sort of given the unique circumstances that we find ourselves under at the moment, and the apprehension from the liners to rush to the yards to order new vessels, is it a question of sort of really having to bear this short-term pain in the quest for long-term sustainability, I wonder?
Well, I'm trying to avoid too many value judgments at this point. The way, the comparison I think I'm most interested in, though, is what happened Q4 last year as compared with maybe a year before. The supply and demand conditions were pretty well the same. The maybe deployed capacity had maybe slipped a couple of percentage points against demand and so on. But what actually happened was that freight rates went through the roof. Now you wouldn't have anticipated that just by looking at the numbers in terms of supply and demand, unless you say, well, the moment demand exceeds supply by 1, then rates go through the roof. And maybe that is the case with some markets. But the other thing that was going on, of course, was the lack of container capacity, lack of equipment. So if you look at last year, whereas North America always seems to lose about 500,000 TEU a year that don't come out again, in terms of that's clearly where containers go to die. That number pretty well doubled last year. Whereas in Europe, most containers, there's quite a very high proportion get restituted, but that doesn't happen in North America. And so I think we know this story, that lines were leaving empties in inconvenient places and peddling back in order to get high-rated cargo to move back across the Pacific. So there was all sorts of things going on. So it may be the way that the lines dealt with that very volatile situation. However, the beneficiaries are the lines. In the sense that freight rates shot up, the volumes were recovered, but the people who kind of suffered, if you like, were the shippers trying to get the cargo on the ships. So I think that might be a bit of a ramble, but I don't think it's entirely to do with the arithmetic of how many ships are being ordered for the future. I think it's also the way the market actually played out, and the impacts it had on the ports, and in terms of creating a cumulative chaos.
And James, I can sort of possibly predict your response to that question, but I'll pass the floor over to you as well.
Okay. Well, I think your opening comment, Jos, was that supply seemed to have matched demand. I think that's partly our problem. It seemed to match demand rather too closely, and the coordination that is permitted by block exemption has clearly allowed the shipping lines to manage the capacity. Such that whereas I think pre-COVID capacity was slightly running ahead of demand, it's now dropped behind, and the demand for space is now, as we see, exceeding what is available. That may well correct itself by demand dropping off, especially if consumer buying patterns change significantly as services and entertainment and non-goods markets start to open up again. But I think the broader and the bigger picture here is that if this is a prolonged crunch on capacity and demand for goods moved does continue to grow at the current rate, there is no short-term fix for this. There are no ships, as far as we can tell, lying idle that can just be brought into play. So that's not just pain for shippers and another episode in the shipper versus shipping line debate. It's far more serious than that. That is going to spill over into serious product shortages, which you alluded to in your opening comments, and the big bugbear of a lot of central bankers and economists is the inflationary pressures this will put on recovering markets. And although that won't be entirely due to the shortage of shipping capacity, it will be a contributing factor. And so GSF, in publicising the messages from MDS's work, is making that link that if this is going to continue, then not only will consumers see product shortages in the shelves or on the websites, but it will start to lead to higher prices, and that will continue to put unwelcome pressure on the rates of inflation in the Western world and indeed also in developing countries.
Yeah, thanks for that. And so, just do you think we could be reaching a time that sort of, I don't know, given the consolidation and the collaboration that's taken place in the market since 2008, and the current position of the market right now, where new entrants and maybe even some of the significant shippers in the market could try and, either through equity or through setting up their own line of companies themselves, compete with the current consortiums?
Yeah, I think what we are hoping for is a fresh look at what we're trying to achieve here, which sounds a very glib statement to make. I think historically, market regulation, market constructs have been in favour of the shipping lines, and I think that if this particular crunch in capacity continues for much longer, I think that will become increasingly difficult to justify as those wider economic effects play out. This is bigger, I feel, or becoming bigger than just simply the normal cycle and twos and fros of the commercial market discussions. Just listening to the frustrations, if not the anger, of exporters, especially in the Far East, especially in Southeast Asia, are just simply not being able to get reliable and predictable accommodation of their goods onto services, and then left being to pick up the bills of demurrage and storage and returns and so on, because these goods cannot get shipped. This is having very, very serious impacts in exporting countries. Never mind the inconvenience and frustrations of goods not actually turning up in more developed markets. So I think there's some quite big factors to play out here. I think to answer the question, I think someone's asked, if in the Q&A, if not this, then what? I think the thing that frustrates shippers is this ability of the lines to quite freely work as one entity, or at least as maybe three entities called the alliances. The shipping industry doesn't distinguish or exhibit any great distinctive features in the service that it offers. It is a commodity service, and if it is a commodity service, then I think the feeling is that maybe that should be regulated as a utility would be, as a provider of services of unique commercial and national interest provided by effectively one supplier. That requires great oversight. It requires greater transparency and a restoration of confidence in the market that actually these rates and these costs are the product of fair competition and not the construct of some special privileged arrangement, which on the face of it just seems to be enriching the shipping lines ever and ever more.
I think you've hit on the sort of crux of the debate there, haven't you? And to play into what Derek has said and also James, one could make the argument that the collaboration that we've seen in the market was essential at the time to continue shipping the goods at a rate that was acceptable to the shareholders of the liner companies. And in actual fact, perhaps we're in a position that the consortia themselves are not going to add more. Well, the liners are not going to add more capacity when all the ships are already in use, and that's a long-term issue. And when you look at the uncertainty in the global economic outlook, you can see why there is some hesitancy, perhaps, in ordering new vessels. But James, do feel free to come back to that. But I think it's also an issue that plays into the port. So I'll let you respond, and then I'll bring James in as well. I'll bring Tim in.
Well, look, I think there are other examples in other sectors, in other markets, where a beneficial level of cooperation is permitted without the blanket and perhaps overreaching effect of a formal block exemption. And I know there are important differences in the market, but it just seems to me the way that the airlines are allowed to code share as consumers of air travel experience it, but effectively they're vessel sharing agreements, but for the aviation industry, but are able to do that by the development of specific agreements between the lines, which are regulated, they're reviewed, they are transparent, it's understood what information is exchanged. Maybe we need to come into this from the other end of the telescope, and rather than just to give a blanket block exemption, say to the lines, go and get on with it, actually, let's get some visibility as to what exactly information is going to be shared and passed between them, and have that more regularly and frequently scrutinized. And that would give some greatest confidence to the market.
Just this is a question that's just come in, which is interesting, and maybe one for Mike. Although I know that you're not in the position of sort of telling the future. Do you feel that the high freight rates are going to be here for the medium term, or do you think they are going to take a knock, as I said in the sort of introductory comments, as and when those government schemes begin to be rowed back?
Well, first of all, back to predictability. The growth in global container demand has been quite remorseless. So, and the lines tend to tell this to their shareholders, so to speak, with a different hat on. And the graphic I showed from 2010 onwards, I think, confirms that. You can sort of rely on 4% a year growth rate or near enough. So I think it's reasonable to suppose that people who have certain competitive privileges should be kind of investing accordingly. Two very quick points though. You were asking the question, could shippers do their own thing? Well, I think the largest shipper into the largest market, North America, is Walmart. And they account for, I think, about 1 million TEU a year. Now, given that the global market's about 150 million TEU container traffic, you can see how small the biggest shipper is compared with the shipping sector. However, I don't know how many people have noticed this, but there's been the most bizarre, I think, example of what happens when you have very high freight rates. There's a kind of impromptu shipping service started from Ningbo and Shanghai to Liverpool using a ship of 850 ships of 850 TEU, because despite the small size of ship, current freight rates seem to be able to support such a service. Now, that sort of is very strange and not very green if you think about it, because the one thing that the shipping lines can really be proud about is how much they've reduced CO2 per TEU moved, halving it over 10 or 12 years. But that isn't how to... Anyway, that's asides. But I think... final point there. If you look back at... And I'm sorry, I'm not going to use Maersk as an example. If you look at Maersk's results in 2018 and 2019, they were making an EBITDA on their ocean sector of 13 to 15% margin. That's quite respectable when it's such a stable market structure. So I don't see why a return to those levels of freight rates is not unreasonable. That's all.
Yeah. And I think just from a port's perspective, it's, you can invest around a 4% trajectory, right? What it's very difficult to do is invest economically, to invest in a whole load of just in time, or just in case capacity, right? That just doesn't work. And I imagine the same is true for rail freight companies, warehousing, etc. So at our end of the spectrum, it's been a real roller coaster ride of trying to, keep James's customers happy, because, they shout at us at least as much as they shout at the shippers. But then it's about, what are your ways? You've got to find ways of working and deploying some elements of like variable surge capacity to do it. So we've been on a bit of a roller coaster with that. It's coming, but it's not, if this is the new reality, then, that's quite tricky for everybody.
And just to build on that, Tim, I mean, when you talk about that surge capacity, how much of that is to do with physical infrastructure, I suppose, and how much, in your opinion, can be achieved by, we hear an awful lot about port optimization products using blockchain and the Internet of Things, and assuring that, ports containers are being offloaded in the most economic fashion, etc. Is that having an impact in terms of efficiency and supporting liners' turnaround times, or are we yet to really see that play a part in the market in a tangible sense?
I'll give you two examples at either end of the technology sophistication spectrum. And one at the more advanced element, or the sexier end, you have actually tracking, identifying where the boxes are, and starting to move to identifying the consignments within the boxes, and helping to give people more visibility about when things are arriving, where they are. If they're not where you think they are, at least you know where they are, and you can plan around that. So that whole data piece is extremely important and becoming more so. At the other end of the technological sophistication end, but probably more impactful at the moment on a day-to-day basis, is basically getting men and women on port, working hard, working more flexibly. Conversations at a local level about, will people work more than their scheduled hours, that has actually been the very unsexy but extremely important way of trying to cope our way through this. So going forward, it is a combination of utilizing your assets more effectively, investing against the general trend, but this whole data and optimization piece is absolutely where we all need to go.
And with COVID restrictions, etc., how straightforward has getting additional people power into the ports been?
It hasn't been. That's certainly made it more difficult. Literally having to wipe down the inside of cabs after every shift, etc., etc. Only 4 people in a minibus. I mean, this is all desperately unsexy stuff, but it is the stuff that makes.
But in a way, it's sort of it's a perfect storm, isn't it? I suppose where you've got liners coming in, literally rammed to the gunnels with containers. On port, you've got difficulty in terms of people power and the additional time it takes to turn around due to the fact keeping everything sterile, etc., etc. It must have been incredibly hard work on shore. And then I suppose also, Tim, there's a knock-on impact to the wider supply chain as well.
Yeah, it is. And let's move to the wider supply. Just briefly on the wider supply chain. Truck driving is hauliers are obviously a big part of this unpredictability doesn't work for them. But at the same, but there are structural issues in that market as well. Here in the UK with Brexit and the issue of how many of our truck drivers were East European. But more generally, just worldwide, the age profile of hauliers, and with the rise of e-commerce, do I want to be spending my time delivering parcels, or do I want to spend it on the road, teens of hours a day hauling to and from ports, right? All of this is contributing into what has been and continues to be a difficult place for the supply chain.
Yeah, absolutely. And I think you've opened up a can of worms there, Tim, which I think we could certainly look to explore in some other conversations. And of course, we haven't even really touched on the impact of Brexit, particularly on that. Maybe not so in terms of actually where the vessels where the vessels come alongside, but in terms of the wider supply chain and how that slowed things down. And I'm sure there's a lot more that we could cover off there. But I think particularly from a Maritime London perspective, where we're certainly most of our members are more used to hearing from the shipping side, from the carrier side of this industry, I should say, this has been a fascinating insight in terms of the pressures that both shippers and port operators are experiencing in the current environment. And we've provided a brief insight in terms of what the future may hold. Mike, I'd like to thank you for couching this conversation in some objective data. And I thought your presentation was really excellent at the beginning, and I think if anyone wants that presentation, it will be made available to attendees, so please do just email us in and we'll be able to send that out. If you have any questions in that you'd like to ask in longer form, please do email us, and we'll make sure they go to the respective respondents. And apart from that, I think that's probably all from us today. So thanks so much for all of the participants today. I think it's been a really fascinating canter through the pressures of the current market. And who knows, we might do this again soon, maybe when the next review is out, to see if perhaps that dip in demand, as we've discussed, comes to fruition. But anyhow, for now, we'll leave it there. Thanks to all of the attendees. And enjoy the rest of this beautiful sunny day. Take care, and we'll see you soon. Bye bye.
Okay.
Thank
Cheers.
you. Bye-bye.
Thank you.